Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. Welcome back to the podcast. I'm Barry Schwartz, joined as always by Ernest Wong. This is the Long-Term Investing Podcast with Baskin Wealth. Thank you so much for joining us. Ernest, did you know that we're popular in Norway?
I had no idea.
So it's Spotify Wrapped season, right? So Wrapped will show you for creators, where your listeners are from, how many listeners find your shows in the top 10. They may tell you what your listeners like to listen to. Guess what our listeners like to listen to aside from our podcast? What do you think is the number one show? Knowing that we skew heavy male.
Joe Rogan?
You got it. Yeah. Joe Rogan. Well, it's the most popular podcast, right? Yeah. I don't know how many downloads or watches Joe Rogan gets per podcast, but we're in good company.
I would say so.
Very nice.
Something to aspire to.
Absolutely. If we can only get part of that viewing audience, I assume everybody likes investing. Why not? It's lots of fun. So over time. So thank you so much for following us. We really appreciate those that follow us on Apple and Spotify and YouTube. Please subscribe when you have a chance. Please leave us a 5-star review. It really helps. It means a lot to us. And the upcoming holiday season, there's no better gift to me and Ernest than for you to give us a great review. So that was a good one, right?
Yeah.
So on with the we'll end the promotion here, and we'll have a fun show today. We're gonna take your questions. We have the mailbag feature. We got a lot of good questions, Ernest, so we're gonna get to a bunch of them, and we're gonna give shout outs to those of you that managed to reach out and ask some very interesting questions. We're also gonna talk about a new old stock that we repurchased in our portfolio. But first, Ernest, let's get to the question that everybody's been asking. Are we in a bubble? Is the stock market going up on thin air? You look at the top 10 names in the S&P 500, represent a good chunk of the S&P 500, probably 40+%. You look at the valuations of those top 10 or the Magnificent Seven, however you want to slice it, high multiples. Of course, everybody can tell us what the multiples look like, but multiples also have to take into account how much free cash flow a company generates, the returns on invested capital, the growth that those companies will deliver over the long term or even in the medium term. As you know, a stock can look very pricey today, but if the earnings grow at a very fast rate, in the future, it looks very, very cheap. So Ernest, you did some work on our portfolio, looking to see how much growth came from earnings or multiple expansion. And what are your conclusions?
So there's, in essence, 3 ways that you can make money on a stock. You can get dividends. Mm-hmm. You can get multiple expansion, so people paying more for the company, or you can get earnings growth. Okay. And obviously, our performance over the last 2 years has been quite strong. Mm-hmm. And so I think it's in many cases, exceeding our own expectations. So sure. I think I thought it was an interesting exercise to go and look and see how exactly we're making our money. Okay. Is it just that is there actually strong fundamental performance underlying the stock price growth, or is it just the market getting crazy and bidding stocks up to bubbly valuations? So dividends are a very small component generally in our strategy because we like companies that reinvest earnings into their businesses, and they don't really pay a lot of dividends. So that was a very minor contributor. But about 2/3 of the returns this year from our portfolio have come from earnings growth. So this is let's say a company's stock was up 20%. If earnings were up 15%, then you could say 5% was due to multiple expansion.
Yeah.
Right. And that's kind of roughly what we see. About 2/3 of our portfolio returns were from earnings growth, and 1/3 was from multiple expansion.
So essentially what you're saying is we own good companies that have grown their earnings quite quickly in 2024. And as a result, the market rewarded those earnings growth. And in your opinion, not necessarily in a bubble for our
Exactly.
stocks.
Right.
Yeah.
So like a pretty good example of that is Constellation Software, which is just basically goes up every year.
Yeah.
Right. But what's interesting about Constellation Software is that it's trading at the same multiple as it did in 2021.
Yeah.
So all of the growth of the stock price is perfectly justified by the strong earnings from the acquisitions that they're doing inside their business.
Yeah. Another example is like Google. I don't know the exact number, but I think it's close to 20% earnings growth this year. The multiple is low, right? I don't think the multiple has gone up at all. So eventually, the bottom line is you got to say the stock is up because of the earnings growth, not necessarily because people are paying more for Google. In fact, they're paying less. Adobe stock is down, yet its earnings is up more than what they told you they thought their earnings were going to be at the beginning of the year. So that's one where the multiple is contracted, yet the earnings are delivering. So we did a good job so far of picking companies that deliver on earnings growth.
Right. And so I think the main point that I'm trying to make is that, we don't really know exactly what the multiple the market is going to assign to these companies going forward.
Yeah.
And there's certainly, in my opinion, there's a lot of silliness out there in the markets today. But for the companies that we own in our portfolios, we're happy that we think the stock price increase is mostly driven because of strong results as opposed to the stock market bidding them up.
Yeah. And when we look out the next few years, we're still very excited about a lot of the stocks in our portfolio, the growth that they're going to deliver. Will they deliver the types of earnings growth that they had over the last 2 years? I don't know. Some may be more, some may be less. But when we look across the board, top down, some companies should benefit from some better tailwinds, interest rates coming down, inflation coming down. Some companies may benefit from an improving economy, both in North America North America and globally. Keep in mind, China's been very, very slow lately. Low-end consumers have been hampered by high inflation and high interest rates. If some of those things reverse, there's reasons to be really optimistic about earnings growth going forward. So even if part of our portfolio has gone up as a result of multiple expansion, if the earnings growth comes in line, those names will look cheap today versus the growth that they could deliver.
Very well said.
Thank you. So let's move on to a stock that we owned for a number of years. We decided to exit the name when there was a lot of controversy. We looked smart for a while, Ernest, when the stock fell 50% from when we sold it. Then the stock, of course, proceeded to go up 5 times from the low. And that stock is Meta. And we're now back into the name. And Ernest is going to explain why Baskin Wealth Management has decided to get back into Mark Zuckerberg's Meta.
So I think this is before we get into the actual investment thesis for Meta, I think that's an important thing to note about how we invest broadly is that, I think it's fair for an investor to look at us and say, well, you guys were stupid for selling in 2022. And given the stock price performance of Meta, I think it's certainly fair to say that.
We looked smart for a few 3-4 months.
Right.
Yeah.
But I think as an investor, obviously I wish we didn't sell the stock.
Me too.
But I think as an investor, you always have to be constantly updating what you know about the company and how things are evolving, and then be willing to change your mind. I think the worst thing you want to be is to stubbornly say, I'm not going to do this,
Yeah.
and refuse to change your mind even if the circumstances change.
Yeah.
And in the case of Meta,
We've all been there, by the way. We've all been where we've owned a stock and we sold it and we regretted it and we never look back, right? For whatever bias, mental bias that we have, stubbornness, or I'm afraid to look dumb in front of a client because they used to own it and I sold it and now I'm buying it back at a higher price. And I know that the client's going to beat me up on that. That's neither here nor there. The goal is to make money from here going forward, not to look backwards.
That's right.
Yeah.
And so that's basically, I think, the situation that we have with Meta, where we sold it at a much cheaper price. We're buying it at a more expensive price today. But I think the future for Meta at the current price is still quite attractive, especially relative to the market and what's out there today.
That's right. And so we just talked a few minutes ago about the market possibly being expensive, the top 10 names having high forward valuations. Meta is one of those that really isn't trading at a high forward valuation, especially compared to the expected growth, the strength of its balance sheet, and so many other things that you're going to get into.
And I think another thing I would say is that I think a lot of people would understandably say, well, why are you buying more big techs at a time when everybody loves big techs?
And not everybody loves them except for the Department of Justice.
Exactly.
Yeah. Okay.
And I think this is a bit of oftentimes the big techs are kind of put into the same bucket just because they're big and they've all done really well. But if you actually look at their businesses, they're actually quite different in terms of the products that they sell, the end markets that they're exposed to, even like the managements of the companies.
Yeah,
like they're different businesses.
A lot of people take it as a badge of honor that they don't own the big techs, right? But that's the goal isn't to be proud of what you don't own. The goal is to
make money.
To make money. And I get it if you don't understand the companies and it fits into that too hard pile for you, fine. But you and I, as investors, if we're going to get better as investors going forward, we have to be open to learning about companies, to be open about changing our minds, to be open about going back to past if it was a mistake in the past to sell it, to look past that and try again to see if it's a different business. And the future will tell that to be the truth with Meta.
So the thesis for Meta. At Baskin, what we do is we invest in great businesses with great management teams. And I think that's what Meta is. It's a great business, obviously. It has, I think, 3.4 billion people in the world using its products on a daily basis, which across Facebook, WhatsApp, and Instagram. They have, I think, roughly 50% operating margins, which is in the top tier, which is really high for most companies. And they have a very well-run, it's a very well-run business. The management team has had a terrific job of, number one, building up the business, as obviously, but more importantly, is reacting and pivoting when necessary.
That's right. There was existential risks to the Meta story in 2022. We can go through those risks. Obviously, Apple, the fight with Apple, the change of the name to Meta, the investment in this metaverse that was money thrown out however you want to do it, money on fire, or money down the drain, flushed down the toilet. Worries about regulation, the threat of TikTok coming out of nowhere and becoming a gigantic competitor, Snapchat, so many risks. But as you've pointed out, Meta, its management has pivoted throughout the years. Remember when it went public? And as soon as it went public, existential risk is, well, everybody's now using these things.
Right.
And Facebook doesn't have apps for the mobile.
Yep.
And it's screwed. And so Mark Zuckerberg, who was only 40 years old,
Yep.
he's got an unbelievable vision. But before we get to those, big broad topics, why don't you dive in a little bit about what you think the next year or so looks like for Meta?
No, I think the main point is that if you go through Meta's track record,
Yeah.
they have a great track record of pivoting the business to meet whatever needs the world expects of social media at the time.
Yeah.
They bought Instagram and WhatsApp when they were still allowed to do these kinds of deals, recognizing that these were potential competitors. When Snapchat launched and was starting to gain share among younger users, they launched their own Reels product.
Yep. Copied a
Yeah,
lot
they
of
copied Snapchat
some
and
popular
yeah.
stuff from Snapchat. Yeah.
Stories was
Sorry. Stories is copied.
Stories
Yeah.
was Snapchat.
Yeah.
When TikTok became a thing, they launched Reels,
Yep.
and has been fairly successful in maintaining engagement. When they saw that younger users are no longer using Facebook, they made some changes to the way the feed works, built things like Facebook dating and Marketplace, and
Also linking all the Facebook family of apps.
Yeah.
Yeah.
together, and like wrap those to moderate success to try and regain younger users in the US. And I think one of the lingering things that a lot of investors have had about Facebook is that social media apps in the history of the internet many of them have come and gone and have been viewed as fads, right? But that's not what Facebook and Instagram are today. They're not just websites that people go in and happen to use. These are like extremely sophisticated machines that are designed to optimize the engagement and keep you hooked to the app.
Absolutely. And
Right.
We know many people who are addicted to multiple Facebook products, whether it's WhatsApp or Reels or Facebook itself.
Right.
Yeah.
And so that's what that's what Meta is today.
Yeah.
And there's good reason to think that it will continue to do that going forward, especially given that Mark Zuckerberg is still the one leading the business.
And it's very interesting to point out that although Facebook, maybe the Facebook Blue is maybe a very mature business in North America, this is a global business, Ernest, right? And so WhatsApp is so popular outside North America. People use it for commerce. They use it for communication. The growth of Instagram and Facebook are still gigantic white space outside North America. More room to add ads and services. So really, the floor is yours. Which sections do you want to touch on? What do you think our listeners would be most excited to hear about in terms of the Facebook or Meta thesis?
AI is probably the most exciting opportunity for Meta. And we talk about AI, but there's two types of AI that Meta benefits from. There's the AI, which is just general machine learning computing that Meta is always investing in to make the experience better of the products. And these are like highly technical things like Facebook Andromeda advertising platform, which are basically it's just a way for Facebook to rank the ads and the content on Facebook or Instagram, just so that it makes it a little bit more relevant, so you spend a little bit more time browsing.
And
right?
it's also good for the suppliers, right?
Yeah.
The 10 or is it 11 million small businesses that use Facebook every day to promote their products and services?
Yes, and they do a lot of this type of investment. These are kind of not really that exciting to talk about, but drive meaningful improvements in the business.
Yeah.
So that's the first area of AI that Meta is investing in. And then the second thing is the generative AI aspects, which you see about in the press, on the newspapers, right? These are things like being able to design emojis using AI, right? Which, by the way, is actually a bigger deal. As a side note,
Okay.
can we take a detour?
Sure.
People often snicker when, like Apple announces an AI product and it's like, oh, you can design emojis with AI. And people are like, well, that's the best you can come up with in this revolutionary technology. But it's actually super important because emojis are what keeps you engaged in the apps that you're using, right? The reason why kids in the US love iMessage is because of the interface and the emojis and the, like
Yeah, it's
the
fun.
green bubbles,
It,
right?
it makes a conversation fun. It's lighthearted. You use it with your loved ones, with someone you want to date, with someone you want to flirt with. I mean, there's so much value to the emoji experience.
Right.
Yeah.
And that's why these things are actually really important for Meta through WhatsApp and Messenger as they compete against iMessage in terms of driving market share and engagement. But anyways,
Okay. Well, just bang my face on that. Yeah, go ahead.
anyways,
Yeah.
and these are the kind of things that Meta is investing in as well.
Okay. So in the future, of course, many people wonder how AI or generative AI will benefit Meta. I think the thinking goes that Meta will say, okay, you come up, Barry, Ernest, you have a product or service. Tell us exactly what it is. We'll look at your website, we'll look at your videos, and we'll design an ad for you. And you don't have to outsource your advertising or marketing to anybody else. And it will be instantaneous, and we can target it directly, and your advertising budget is zero, right? That's the Mark Zuckerberg vision.
Well, yeah, maybe not zero, but
Yeah.
yeah, like I think that's the kind of understated benefit to Meta is that on the advertising side, the ability for them to automate using AI a large portion of the advertising creative process. So being automatically able to generate advertising, being able to fit formats and just make it a lot easier for you to a small business to advertise. Like these are things that drive meaningful improvements in their business. And beyond that, to the extent that AI makes it easier for everybody to create content, right? Now you and I can, type up a prompt on DALL-E or ChatGPT and immediately generate images or a video of how to bake cookies or whatever.
Yeah, whatever.
Meta and YouTube are going to be the places where people look at that content, right? So those are the
Meta and YouTube, yeah.
Yeah. Instagram, Facebook, and YouTube.
Yeah.
These are the places that people are going to be posting and sharing this content. So I think there's going to be a lot more opportunity for them to increase engagement and gain eyeballs from AI.
And as Ben Thompson said on his blog, those that have the distribution will be the winners in this creator economy where there's an abundance of content. The ones that can produce the distribution that get the eyeballs, that's Meta, as you pointed out, that's YouTube. And of course, this thing that gets you to those, the content, that's the funnel, Apple. Meta's, of course, working on so many. It's not just a services company. What is Zuckerberg's vision? Social technology company, is that his goal? Right, so it's not just social media. It's focusing on hardware, focusing on video games. You name it. There's just so many things that they're working on, and of course, trying to control their own destiny by not being subject to the Android or the iPhone, right? That's the goal, is to have the glasses, these, what do they call them? Is it Project Orion?
Yeah.
Yeah, so that the goal is that you and I, and we're both wearing glasses. Why do we need an iPhone? We can just turn on or off the experience with our glasses, and it's close to our ears, so we can listen, we can see, we can talk. Instead of looking down, as Zuckerberg says, which is such a waste of time, you can explore the world, turn it on and off, and that's the long-term vision of Facebook or Meta. Don't know if that's going to take off or not, but a lot of the world wears glasses already, and that's the thinking.
Yeah, and so that's basically a high level of what we see with Meta today.
And all that wrapped up in a pretty good valuation, right? Trading at about 23, 24 times forward earnings for one of the highest quality companies. You talked about just, strong margins, good revenue growth going forward as it continues to launch more services, get more returns on investments from better advertising for its customers. Obviously, a lot depends on the economy, of course. If the economy is doing well, people want to advertise. If the economy isn't doing well, maybe they want to advertise more. I don't know. But ultimately, we saw in downturns, the advertising market, that is one risk with Meta, of course.
I think the other big risk that people usually talk about for Meta is their investment in Reality Labs,
Yeah.
their VR investments. I think they lost about $50 billion so far on this division.
Yeah.
And the motivation for this is really to control their own destiny and not be subject to the encumbrances and the taxes that Apple and Google place on their business. There was an interview, Zuckerberg gave an interview recently on the Acquired podcast where he said they've done studies on how much money they lose due to the restrictions on these platforms. And he said, it's hard to say exactly, but he thinks that Meta could be twice as profitable if they own their own platform, which really gives you a very, very strong incentive to be investing in in hardware and being able to do that.
So Zuck isn't going to try and launch a smartphone.
They've tried.
Yeah.
And it failed.
It failed, yes. And you have to give Zuckerberg credit, the team credit. They've tried a lot of different things. Some things have failed. Some things don't work, and then Apple copies. They had this portal thing that I don't know if it's working, but looks like Apple's coming out with their own version of it. So Mark Zuckerberg and his team are usually first to a lot of products, even though they're good at copying as well. So we'll be talking about Meta, I'm sure, over the next year. We're excited to have it in our portfolios, and we hope to add more to it, especially if the stock doesn't work. That's what we're looking for. Buy more on dips, Ernest.
Yep.
All right. So let's get to our feature of the podcast, which is our mailbag.
Oh, that was the feature?
Yeah, that's the features. We want to feature you. No one wants to hear us talking. They want to hear the questions from our audience, and we've got some great ones. And so, Ernest, why don't you start with the first one, and make sure to read out the name and give a shout out to the handle.
Okay, so first one is from Andy at Biz Almanac.
Oh, you got to follow Andy. He's terrific. Okay.
What have you changed your mind about recently? Well, that one's easy.
Yeah.
Changed our mind about Meta.
Yeah, totally. Okay.
So I think it's worth talking about what exactly we changed our mind about.
All right.
Because when we sold the stock so we owned the stock from about 2017 to 2022.
Yeah.
And when we sold the stock, throughout those 5 years, it was a rocky ride.
Yeah.
First, they had the Cambridge Analytica scandal.
I don't even want to remember that one, but yes.
Yeah.
Yeah.
With the data.
Yep.
They had COVID.
Yep.
And then went up, and then it went back all the way back down because for a variety of reasons. And what we saw at Meta at the time was that after the pandemic, they were losing users, engagement was declining. TikTok was, there were cyclical factors as well as competition. So TikTok was clearly eating their lunch. And they were facing issues from Apple regarding their privacy practice, Apple's privacy practices, which limited their ad targeting ability. And then lastly, they were pouring billions of dollars into the metaverse and Reality Labs.
And we talked a lot about this during those periods, Ernest, where we said, what are we doing? Why are we owning this company where they're facing so many challenges? Why don't you just own the king, Apple? Why don't we just, why are we fighting a company that's subject to these taxes on Apple, these taxes from Google? They don't have control over their destiny. And at the time, it made a lot of sense.
Right.
Yeah.
It made a lot of sense at the time. What we saw that changed our mind was that, number one, I think Meta has been more disciplined about expenses than about how much they spend on the business overall than we initially thought. So first of all, there was the whole year of efficiency thing that Mark Zuckerberg talked about.
And worked tremendously. I think margins went up by 10%.
But Meta's always been a fairly prudent company with regards to managing costs. If you look at the losses they have on Facebook Reality Labs, the virtual reality division, it's been fairly stable as a percentage of their overall losses.
Good point.
Overall profits.
Yeah.
So it does seem to be a ceiling on how much he's willing to spend there. And just broadly speaking, Meta earns more in revenues per employee than even like companies like Google and Microsoft, which is good efficiency. So that's number one. And number two is that we underestimated the ability of the engineers at Meta to invest in to solve the problems that they were facing with regards to ad targeting. So they switched to, now this is getting super technical, but they switched to probabilistic models where they take a lot of data and to be able to estimate the probability that the ad is going to be like targeted.
So prior to that, Meta or Facebook had all your data because they knew what websites you went to. So it was deterministic, right?
So before, the way it worked is that if you saw an ad for like cuisine art blenders or whatever, then you click that link, then you bought it. It brought you to the cuisine art website, and then you bought it, right? There was a signal that would be sent back to Meta that you clicked the ad and you bought the product. Apple cut that connection away.
Got it.
And so they had to develop other models to be able to evaluate whether the ad worked or not. And so they did that. They built models. And more importantly, like other companies could not do this because Meta is so big and has so many users.
Beautiful.
So they actually gained market share relative to other competition.
And now, of course, AI and machine learning will even help Meta determine or even more what you're interested in and the probability that you're going to click on the ad and so on and so forth.
And then they've built other stuff like click to messaging ads and shop ads and all these kinds of things to help measure whether you've actually completed the transaction. So that's number one.
I think that's number two, but I can't keep track of your.
That's number two.
Yeah, you got a lot of numbers.
And then I think the last thing is, I think it's relevant, is the valuation of the stock again relative to both our portfolio and the rest of the market, because as you pointed out, everything is up. And there's not that many like cheap stocks anymore. So that's what we've changed our mind about.
I think one of our blind spots, of course, and we're trying to apply that to other businesses and being more patient going forward, is that the core business is just so damn good and spitting off so much free cash flow that we can be a little more patient if the CEO has a pet project that may not work out, even if they're throwing out a lot of money on it.
Can I make a comment on that?
Yeah.
So a lot of analysts like to back out Facebook's spending on Reality Labs to calculate an earnings multiple.
Well, I think they're trying to do that to get a sense of how good the core business is.
Yes.
Okay.
That's true.
Yeah.
But I think given that the motivation of this is to own their own platform, you can kind of view the spending at Reality Labs as the cost of the Apple tax on the business. So I don't think it really necessarily makes sense to back it out. But that's neither here nor there.
I just think that if you did back it out, you would see how good the core business is, and you would slap on a valuation of the highest quality multiple that you could find. And I don't think the market is actually doing that. And so maybe that's a way to just rationalize why it's trading at such a low multiple, because it doesn't make sense. All right, let's move on. Which one do you want to do next?
We could do this one.
Circled?
This is a good question.
Okay.
Curtis
Quesnell.
Hope I'm pronouncing it correctly.
He's at Curtis Quesnell 3. There must be more than. Is there more than one Curtis Quesnells? Okay, Curtis, thank you for your question. So go ahead, Ernest.
In the past, Baskin Wealth has identified great small to mid-cap companies that have turned into serious compounders, such as TFI, Waste Connections, First Service, and TMX Group.
This is someone who's following our portfolio so thank you, Curtis.
Will Baskin ever consider picking from this space again in the future? This is where money is made.
All right, well, I have a problem with that last point. This is where money is made. But so the question, I guess, is in the past, you guys may have picked some small cap names that worked out and have become tremendous companies. This is first of all, Curtis is cherry picked 4 of them. Thank you for cherry picking the 4 that have worked, but there have been many others that did not work. So, small cap or mid cap investing does come with risks. But it goes to show you that if you pick 3 or 4 good ones and it works out, the results can be tremendous. You and I obviously have screened and gone through the TSX
Yes.
and not as much the US market, but the TSX over and over and over again. And there's not that, we just can't find at the moment any new companies to add to the portfolio that we're excited about. And I guess, Ernest, if it was a mid cap name or a small cap name that we were super excited about, even if it caused liquidity issues, we would do our best to try and get into the portfolio.
Right.
Yeah.
Well, I think one of the barriers is that we're a much bigger firm than we were even like 10 years ago.
It's fair.
And so just due to managing a concentrated portfolio, it's much harder to be able to buy enough stock of like a $1 or $2 billion Canadian company,
yes,
given the liquidity that exists.
Yeah.
And I think another barrier overall is that our strategy is really to own like the industry leader, because there's a variety of benefits to being the leader, right? So people often ask us why we own like Canadian Natural Resources and Tourmaline Oil over like any random mid-cap or small cap oil and gas company. And I think there are like plenty of really smart analysts out there that, that are sector experts that understand and can find great managements that belong to those areas. But the risk is that they don't have scale benefits. You have more upside if it works out, but then they generally lack the ability to negotiate and scale, to access markets, and all those kinds of things that provide defensiveness to the company. And so I'm sure somebody will make a lot of money buying those kinds of companies, but it's not going to be us.
That's right. And the bottom line, Ernest, we have purchased some quite large companies over the past 1, 3, 5, and 10 years that you would have said, you and I were having this conversation before, people would have said when Apple was a $300 billion company, that's got to be it. It's already the world's biggest company. How much more can it go? And now it's up 10 times from then, right? So with some of these mega cap companies who have large addressable markets, who could get into gigantic other areas from here, there could be more riches to come for those companies. So market cap shouldn't be a limiting factor on the upside as well as the downside for any investor, in my opinion.
Okay.
All right. What do you want to? What's the next one?
Okay, this one at Sempiterno Invest. I guess invest.
Oh my lord, that's a tough. Sempiterno Investments. Sempiterno _INV. Thank you so much for your question. And your question is,
what company do you really like but have never invested in? For example, in my case, is Costco.
Yeah, so we did like Costco and we did buy it, but I can understand those right now, looking at Costco stock over the last few years and saying, holy smokes, that stock has gone up a lot. The valuation is up a lot. I missed it. Obviously, the biggest, the worst words in investing is I missed it. Don't miss it. Go back and do the research and decide if going forward you should invest in it. But Ernest, I guess let's go with yours first. What company do you really, really like, but you've never invested in?
I think usually these are companies that are high quality businesses that do a really good job of managing their operations, but are maybe a little bit more questions around longer term growth opportunities and valuation.
Okay.
So 2 names that I think have done a good job is O'Reilly, which is an auto parts distributor, who followed for probably 6 years now and didn't buy, maybe incorrectly, but we never invested in it.
Yeah.
I think another one is TJX.
So funny because I wrote a list of 1, 2, 3, 4, 5 stocks, and 2 of them are on that list. I also mentioned Rollins, the pest control company, TJX, like you, O'Reilly, MasterCard, although we own shares of Visa, so very similar business, and Sherwin-Williams, the paint company. And I guess you and I have an old school appeal to some of these companies. They're so well run, high returns on invested capital, strong management teams. A lot of them generate a lot of cash flow, leaders in their industry. But I think for some of them, we couldn't get excited about the valuations based upon the current growth that they're providing. That turned out to be wrong on all those names, and I would say that again on. I'll ignore MasterCard because I haven't done enough research on MasterCard, but I would say for Sherwin's and O'Reilly, Rollins, and TJX, the valuations today, given the growth that we see, doesn't get us excited about buying those stocks. But maybe we should buy them.
Yeah. I think there was a similar question that was, which company have you studied for a long time but ultimately decided not to invest in, or something like that. I don't remember who tweeted it.
I didn't copy that one, but yes, thank you for asking that question.
And there's a lot, because every time there's like a high quality company that a lot of smart investors like, we generally try and take a look. And we've passed on a lot of, or declined to invest in a lot of these companies. And in many cases, it actually worked out because
they're high quality companies.
No, I mean the not investing.
Oh, not investing. Okay.
Not investing has worked out.
Give a couple examples.
So, and this says nothing about the valuation of the companies today or what's going to happen going forward. But Starbucks has been one that we've looked at for a long time. There
was a chance when we could have bought it and made money, I think in the mid 40s.
Yes.
But since then it's kind of been a zombie.
I think we thought the coffee business is a really good business, but unsure about their China investment and just exactly how it'll play out. And it actually worked out.
I just never understood. My wife goes to Starbucks every day. She gets a chai latte. The price of the chai latte I now think is $6.15. When she started buying it was $3.50. But I never understood the Starbucks appeal. To me, the coffee tasted terrible. The food was terrible. And the food was pricey for terrible food. So it just never appealed to me. You may say, well, Barry, you own Domino's Pizza. The food is terrible.
I like it.
But Ernest likes it. So that's that at least one reason why I don't own Domino's Pizza. But it never appealed to me, Starbucks, in the same way.
Yeah, and there's a long list of
a long list. Is there a name that you studied that you thought you're pounding the table for us? I don't think there ever was.
And we usually end up buying it some form or some way.
Yeah. I would say that Couche-Tard is a name where we presented it to the investment committee 3 times.
Yes.
Before finally buying the stock. And so we're finding our pitch. There were concerns about where growth was going to come from or capital allocation. Those concerns are always wrong. And so I think you just got to keep studying the company. And if you really love it, you may not have missed it. And in the case of Costco, for example, there may be opportunities for you to buy it in the future if the stock underperforms for a bit and you have conviction in the long term. I think we got time for one more.
Okay, how about this one? Javier Durovic.
Yeah.
Being that many of your holdings trade in US dollars, how do you manage currency fluctuation risk for your clients?
It's a good question. So just to explain, the bulk of our clients are Canadian. They live in Canada. If they're retirees, they probably live off Canadian dollars. They need Canadian dollars. They may travel to Arizona or Florida or Palm Beach in the winter and need some US dollars, but they do need Canadian dollars. So he points out a good question. Is Javier? He points out a good question of you're owning a lot of US stocks. You are taking currency risk. How do you manage that? What would you say?
Well, we don't hedge or use derivatives or anything like that. I think one thing that is often underappreciated about currency, especially with regards to Canadian and US, is that it's not necessarily just US go up, US dollar high, so own US stocks, and then US dollar low, like sell US stocks, because it's a little more complicated than that. A lot of the companies that we own, the US companies that we own, are global companies that that make a lot of money outside of the US. So to the extent that the US dollar is weakening, they would make more outside of in other markets.
Yeah.
And so they do have like a currency gain. And kind of vice versa for the Canadian stocks that we have in our portfolio today, where the Canadian dollar is weak, but
Yes.
they have a lot of the companies have big operations in the US. So they're actually making more money because of the weak Canadian dollar translated back.
No question, Ernest, if the Canadian dollar goes up big from here, that would be a short-term headwind to our portfolio. We own Canadian companies that are exporters or have a lot of US dollars. The translation would hurt them. We own a lot of US stocks. Obviously, the translation of the US dollar back to Canadian dollar, if the Canadian dollar goes up, hurts performance. Of course, it could help the multinational US companies. And that could help their stock prices and be somewhat of an offset. We have benefited, our portfolio returns have benefited by a drop of the Canadian dollar over the last 2 years, but not really that meaningful. And I don't believe that the Canadian dollar is going to fly back up to par anytime soon. It could happen. You and I don't know. But I always say, thinking about currency fluctuations is like trying to pick up nickels in front of a steamroller. Focus on the quality of the company as long-term investors. The currency ins and outs, the moves here and there are going to even out, and it should not matter. Focus on owning a company that you think is going to compound and invest those cash flows at high returns, and everything will work out fine.
Well said.
And with that, we are so glad you could join us, and we'll see you back here real soon. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.